In late 2024, a multi-billion-dollar artificial intelligence startup was quietly sliding toward complete financial ruin. It had spent hundreds of millions of dollars buying expensive microchips and building massive data centers, yet when its revenue stalled, not a single traditional bank stood to lose a dime. Wall Street's biggest commercial lenders didn't hold its loans. Instead, the entire debt belonged to a secretive network of private investment funds operating far outside the regulated banking system. This is the hidden world of private credit, a multi-trillion-dollar shadow economy that is quietly financing the modern AI boom. It is growing faster than almost any financial market in history, operating completely under the radar of government regulators and setting the stage for what could become the next catastrophic financial crisis. To understand how this hidden financial empire was born, we have to travel back to the aftermath of the 2008 global financial crisis. When Lehman Brothers collapsed, it triggered a worldwide economic meltdown that forced governments to step in with draconian regulations. Legislation like the Dodd-Frank Act placed strict, unprecedented limits on commercial banks. Institutions like J.P. Morgan, Citigroup, and Bank of America were suddenly forbidden from issuing high-risk loans to unproven companies or deeply indebted corporate borrowers. Governments wanted to ensure that traditional banks would never again fail and require a taxpayer bailout. But while these rules made traditional banks safer, they created a massive problem for the broader economy. High-risk companies still needed capital to grow, and wealthy investors were desperate for high returns in a zero-interest rate world. This mismatch created a massive vacuum in global finance, and Wall Street quickly moved to exploit it. Private equity firms and asset managers realized they could set up private funds, gather billions from institutional investors, and lend money directly to businesses. Because these private lenders were not traditional deposit-taking banks, they were completely exempt from standard banking regulations. The age of modern private credit had officially begun, setting off a quiet revolution in how corporate debt is issued. Unlike traditional bank loans or public corporate bonds, private credit operates entirely through direct negotiation between a private fund manager and a corporate borrower. There are no public filings, no credit ratings from agencies like Moody's or S&P, and no public trading markets. Everything happens behind closed doors. In the beginning, private credit was a niche tool used mainly to fund small, struggling companies or leveraged buyouts. But over the past few years, a massive new catalyst entered the scene: the artificial intelligence revolution. Building advanced AI models requires staggering amounts of capital. Companies need billions of dollars just to purchase thousands of high-end NVIDIA graphics processors, construct massive data centers, and secure dedicated power grids. Traditional banks look at AI startups and see terrifying risks. Most of these startups generate minimal profit, burn through cash at an alarming rate, and rely on hardware that could become obsolete in 2 years. Commercial banks simply cannot justify giving them multi-billion-dollar loans. Enter the titans of private credit, firms like Apollo, Blackstone, and Ares. These private lenders stepped in to offer vast sums of debt financing directly to AI firms and tech infrastructure builders across the globe. But this money comes at a steep price, carrying high interest rates and taking physical AI chips as collateral. Today, the private credit market has exploded into a staggering $1.7 trillion industry, with analysts estimating it could soon reach $3 trillion in the very near future. On the surface, it looks like a win-win scenario. Tech companies get the billions they need to build artificial intelligence, private equity firms collect massive management fees, and wealthy investors enjoy high double-digit returns. But beneath this glittering surface lies a web of systemic risks that threaten to unravel the global financial system. The first critical risk is total opacity. In public bond markets, prices are updated every second based on supply and demand. If a company struggles, the price of its debt falls publicly, warning the market of danger. But in private credit, there is no public market pricing. Private fund managers value their own loans internally behind closed doors. If a borrower falls behind on payments, the private credit fund can simply alter the loan terms, allow the company to pay interest using more debt instead of cash, or keep the valuation at 100 cents on the dollar. This creates a dangerous illusion of stability, convincing investors their money is safe simply because losses are hidden. The second major risk is severe illiquidity. When people put money into a bank or buy shares in a stock, they can withdraw or sell their assets relatively quickly. But private credit loans are completely illiquid, locked up in complex agreements for 5 to 7 years. If a market panic occurs, investors cannot pull their money out because the funds simply freeze redemptions. The third and most explosive risk is the AI debt trap itself. Tens of billions of dollars in private credit loans are secured by a single asset class: high-performance AI chips and data centers. Lenders issue these loans assuming these specialized chips will maintain immense value for years. But tech hardware depreciates rapidly. If next-generation chips render current hardware obsolete, or if generative AI fails to generate promised revenues, these tech startups will default. Private credit funds will be left holding billions of dollars in depreciated silicon chips that no one wants to buy. To make matters worse, private credit funds have quietly borrowed money from traditional banks to leverage their own lending power. This means traditional banks are indirectly exposed to the exact same high-risk corporate debt they were forbidden from touching in the first place, creating a circular chain of hidden leverage connecting tech startups, private funds, pension funds, insurance firms, and major commercial banks in an interconnected web of high-stakes debt. If this setup sounds eerily familiar, that is because we have seen this exact movie before. Leading up to the 2008 financial crash, the banking world created a shadow system of subprime mortgage bonds and complex derivatives. Regulators assured the public that risk was manageable, and rating agencies stamped these hidden assets with stellar approvals. Everyone believed the system was bulletproof, until home prices stopped rising, borrowers defaulted, and the entire hidden apparatus crumbled in days. Today, private credit is replicating that pre-2008 shadow structure almost line for line. The key difference is that instead of subprime housing loans, the system is backed by speculative AI ventures and corporate debt. What happens when the tipping point arrives? Imagine a scenario where a major AI pioneer fails to deliver on revenue promises and defaults on a multi-billion-dollar private loan. The private credit fund hosting the loan is forced to mark down its assets, triggering panic among its investors. Large institutional clients like state pension funds and university endowments suddenly realize that their retirement capital is trapped in non-performing tech debt. As confidence shatters, private lenders stop issuing new loans. The flow of credit to the tech sector abruptly dries up. Companies that rely on rolling over their private debt suddenly find themselves unable to refinance, sparking a wave of corporate bankruptcies. The illusion of safety evaporates overnight, exposing the reality that shadow banking never eliminated risk. It simply hid it in plain sight. The rise of private credit represents one of the most profound transformations in global finance since the creation of modern banking. What began as a clever regulatory workaround after 2008 has metastasized into an indispensable pillar of international capitalism. Today, private credit powers everything from regional software firms to the hardware infrastructure powering artificial intelligence. It has quietly redefined who controls capital, who assumes risk, and who reaps the rewards in the modern economy. Governments and central banks around the world are finally beginning to sound the alarm. Regulators in the United States, Europe, and Asia are scrambling to gain visibility into these dark corners of finance, demanding transparency from megafunds and warning of potential systemic contagions. But regulation moves at a glacial pace, while private capital moves at the speed of light. By the time regulators fully understand the true extent of leverage and vulnerability hidden within the private credit market, it may already be too late to prevent a collapse. As we stand on the precipice of an AI-driven future, we must confront a fundamental question about the architecture of our financial world. Is private credit a triumph of free market innovation that provides vital fuel for technological progress? Or is it merely the ultimate financial shell game, designed to enrich fund managers while shifting catastrophic systemic risk onto pension funds, retirees, and the broader economy? When the next economic storm arrives, the panic will not start on the trading floors of the New York Stock Exchange or inside the grand boardrooms of central banks. It will begin quietly, in the dark, unmonitored vaults of shadow finance, where trillions of dollars in hidden debt wait for the spark that will set the system ablaze.